Welcome to The Investor, a podcast where I, Joel Palafinkel, your host, dives deep into the minds of the world's most influential institutional investors. In each episode, we sit down with an investor to hear about their journeys and how global markets are driving capital allocation. So join us on this journey as we explore these insights. All right, excited for the episode today. I've got Anton at Flashpoint VC. Pretty good friend. I've known him for a couple of years now, but met him at a happy hour maybe about 3 weeks ago. And I was like, look, you know what? It's time for you to get on to the YouTube show, onto the show. So excited to have you here, Anton.
Pleasure to be here, Joe.
Good to see you. And let's just catch up on all things VC and asset management. So let's maybe start with your background. You know, your career. Where did you study? What were kind of the industries that you focused on, and how did you get into VC?
Yeah, it's been a long time already. So, but my dad is a laser physicist from Russia. So
a laser physicist.
Laser physicist. Yeah.
Okay.
So just like my dad, I thought I wanted to be a laser physicist.
Oh wow. Okay.
And so he immigrated from Russia in 2000. Different country back then, different environment. I think everybody wanted to get into Russia, not out of Russia. And so we immigrated. It might sound, hilarious, but we immigrated to Alabama. So I went from basically a capital of oil money into backyard of America.
Yeah.
So quite an interesting transition, I must say. And
what was in Alabama? Was there like a laser?
Exactly. So he got a position as a research professor. Together they reunited with his old friend, and he did a few stints, but Alabama is where he ended. So I went into middle school, then high school, but then it was time to get to choose college. And education is actually free in Russia, so I decided to follow my dad's footsteps and basically moved back in 2004 and get into college and basically studied to become laser physicist. Roughly by senior year, I kind of figured out, okay, like it's unlikely to be my thing, and so I got into business and finance. Basically like as an applied math and physics major. Finance wasn't hard thing to pick up, so did this certification of CFA, like level 1 exam. Kind of got my education in finance through just the book, and got into KPMG corporate finance. Did that for about a year, then ended up on the prop desk of a large institutional pension fund manager, basically doing a lot of bond trading and a little bit of equity. Then it moved a couple of years down the road. It moved into kind of a private equity gig with one of the previous guys that I worked in the pension fund. Then I did my startup because it was quite a vivid times. Everybody was Facebook just did an IPO. It was still Facebook, not Meta then. So a lot of venture capital dollars were unlocking back in 2011, 12. And so tried my entrepreneurship gig, figured that this is what it is to build a product. But once we got to about the seed stage, 20K of monthly revenue, figured that it's actually not something that I'm too passionate about. And I met two guys, investment bankers from Morgan Stanley and UBS, and they just launched their first fund. It was like a $10 million fund. And so I pretty much joined the organization. And over the last decade, we basically built that into 500 million assets under management, multi-product company with not just VC, but also venture debt and a secondary arm. And so today we manage about 6 funds. But the strategy has remained the same, as to focused on founders that are coming from very good STEM background, basically Central Europe and Israeli founders, and they go global. And so mainly because there is access to capital is cheaper in those regions.
Yeah.
And so, and then there's no local markets there. So they have to go global. And so you basically go for founders that are, that have global aspirations, but, tighter access to capital. And so you end up winning on alpha, and that's where you build return. It's very hard to make return in the US, but like in other parts of the world, it's quite possible to do.
So for the audience, let's unpack how a prop desk works versus a typical trading desk, right? So I'm assuming, a typical trading desk, you're working for a hedge fund, there's asset under management, and you're a portfolio manager, right? So you're managing, because of your seniority, you're managing a certain book of business, which is, I'm assuming, LP's capital. But a prop desk, tell me the difference. I mean, prop desk, from my understanding, it's what it sounds, right? They prop up some capital and they give you this capital to kind of just trade again. I guess, can you
well, basically, it was 95% it was pension money, and so it was pretty conservative strategy.
So it's not like billions, right? You're actually buying very conservative.
Exactly. So 95% is like very conservative portfolio. You buy 3-5 year duration bonds. They give you 3-5% yields. Trying to optimize where on the yield curve should you position yourself so you can get extra 20 bips return. But 5% of that capital was pretty much like you can do anything. And so as a physics background person, I said let's look at technology. And it was a vibrant sector. It's one of those industries that have high growth. And so if you look historically in terms of what has been building up value, it's been high growth stocks pretty much. And so because market caps tend to very much correlate with revenue growth and market capture, and so technology companies are the ones to basically capture it. In the late 70s and 80s, there were also consumer companies, but I think over the last 2-3 decades, it's been mostly tech companies that really grasped the market value.
Yeah. So on the trading side, how are you doing the rebalance? So I know, essentially typical portfolio managers that are managing money for a buy side equity shop, a large buy side firm, they're managing their weightings, they're managing their holdings, they're also calculating, they're also reading a lot of news, right? So would you say kind of your practice is similar to kind of a portfolio manager doing more conservative investments? Because some of these portfolio managers for large buy side investments, they're not actively trading. They're doing a lot of long-term research in a certain sector. After they do that research, they read the news, and then they kind of look at what the market is doing to drive their holdings, and then they kind of periodically rebalance. So how often were you rebalancing at a bond?
Well, yeah, on the bond side, I mean, you because the position was quite large. It was basically like a few $1 billion. And wow. So basically there was a risk management department that kind of set the frameworks, which sectors you can go and up to how much. And then on the prop desk, it was basically debt research, to make sure that we select the names that are better, and there were a few traders executing that. On the equity side, basically there was a little bit more room. It was more, I'd say, risk reward driven, and so you basically look for arbitrage. If you have two companies that are relatively operating in the same market, and one is valued 30-40% cheaper than the other one, and then you have certain factors that they could impact that value unlocking, you basically bet on that, and if you want to hedge that against the index, you could do that. And so that was more absolute return driven, and so name specific. But the bond part was more like kind of sector allocation and trying to beat the index by like extra 1.5%. And so if the index generates like 5 and then you do like 6.5, then you've done well. So there you don't expect to outperform the index that substantially by picking the right name, because everybody kind of correlates with how the interest rate market moves. And
no, that makes sense. And then tell me a little more about the path into VC, right? So the prop desk was really interesting. You probably did a lot of quantitative management. You definitely learned a lot of risk management. So what do you feel like some of that laser physicist was in you to kind of be like, look, let me laser. Whenever I think of lasers, I think of like Jetsons, sci-fi, and the future. So you feel like that curiosity kind of drove your interest in technology?
Yeah, I think there's a lot of similarities, in terms of being inside kind of a lab and being inside of a startup and managing a VC fund. Because at the end of the day, like, what's a business? A business is a set of experiments. And I mean, some people like run that business, and that's how we like run ours. Basically, any idea or any startup ultimately is a set of hypotheses. Whether like it realizes or not, depends on whether whether you're right or not, and whether the team that was able to run those experiments is good or not. But there's a lot of similarities. You set certain assumptions, and then you verify certain assumptions against that. And in the physics world, that assumption could be, can you construct a certain laser system? Will it be like powerful enough to power the next system? And in business is, can you bring the churn to a certain level that it makes interesting to basically put more money into sales and marketing to basically scale that business? And so like running a business is a lot like running multiple physics experiments, and running a VC fund is like running, few labs, which, if they tend to perform, you put more money in them, and then they tend to scale, hopefully to a big size. So, so the way that we've quantified our VC business is basically taking that approach as risk reward basis in terms of how we allocate dollars. So it's very IRR driven and DPI as a result driven, because we look for how much return can we generate from any specific private market investing. So it's very much similar to what the microcap stock investing is. You get on a liquid stock initially, and then if you're right and the company gets to 10, 20, 30, 50, $100 million of revenue, that illiquidity disappears. Most companies, especially if you tend to focus on B2B software companies, upon reaching about $10 million of revenue, you get a lot of interest from private equity buyers, and then also strategic tend to be more active around them because you've built or captured a portion of the market, and so the liquidity discount starts to disappear. So your job as a fund manager, and we were investing predominantly at like Series A stage, when there is like kind of $1 million or $2 or $3 million of revenue, is to predict, in a sense, what's the likelihood of that experiment to reach like a $10 million mark with our capital. And so, and if we're right, that becomes liquid. How far will it scale? It's a matter of kind of another topic. And some businesses scale, to $100 million of revenue, $200 million of revenue. Some businesses.
How quickly are you looking to get to 10 million? Because you're doing Series A, right? So a couple of years.
Yeah, I mean, in a sense, like the better performing portfolio companies, tend to triple. Companies that have challenges, either because of churn levels or regulation, or long sales cycles where it might be like very dependent on how the whether the market is buying or not. In 2022 wasn't like 2023 wasn't an easy year, especially for enterprise customers. You might take like 3 or 4 years. If it takes 4 years to get from 1 to 10, likelihood that this company will have challenges scaling beyond 10. But we've been in shareholders in like chess.com since 2012, and sometimes you get surprises by the market. First pandemic hit, then Queen's Gambit hit, and the business went quite viral during that period of time, and so it took a while to get to that double-digit mark. But then once it was the market leader in that segment, and then the certain factors hit, the business almost unfolded in the course of a couple of years from a $10 million mark. So you might get sometimes surprises by the market, even though you quantify the decisions, you get an externality that is a positive externality.
Yeah, no, I agree. I mean, so tell me a little more about the private equity side. So what were some of the things that you observed, the just notable things that you saw, when you were working in private equity, and then how has that evolved? Maybe at the revenue level, the business type level, maybe funds that are investing in private equity. Just what's changed since you've been in private equity?
Well, that was like more than a decade ago, and I think historically private equities have been much more offline businesses focused, and so as however the challenge in those is that you don't really have substantial growth rates. So all of the real like return drivers have been either around consolidating other businesses, and so you're unlocking this.
But they're already most of them are probably profitable, right? They're even
and then they're like profitable, and so you might have some operational improvement, driving EBITDA margin from like 20% to 25%. You might have some multiple expansion. You always like we're making money by taking leverage, and so there were I'd say those were the factors how people like mostly return money. I think 10 years forward, I think today, and that's partly why private equities has really moved into the space, is that technology companies, they tend to still have inherent growth rates in them. And so that's why you see PSG and firms like PSG and like Thoma Bravo basically taking a big piece of the market, because it's not just being operationally prudent and making that EBITDA margin improvement, and not just taking the debt and doing the right transaction structuring, but because software companies, they actually have embedded growth in them, predominantly because there is a net dollar retention component. And so if you'll decompose, where, I think private equities today also make money, a lot of that, I don't have the data to back it up, but my gut feel is that like a lot of private equities really make money by just internal growth of their core platform business. Yes, you get a lot of the, let's acquire some companies, but a predominant also portion of it really comes from just the business growing by itself.
Yeah, I mean,
I think
my question to you was, what industries were you in? Because I appreciate there's a lot of software now, right? Where private equity is playing, but how involved was software in the VC space? Like, where were you playing? Were you doing software back then on the VC side, or was it more like
no? It was more traditional economies. So
like healthcare.
So there were, so we were looking at doing like some agricultural farms and like how to acquire a couple of them and then merge and do operational improvements. So it's like more financial case. But it was nothing related to technology, to be honest. And so that's why I actually went from a private equity stint and like build a startup, because it felt a bit slow and a little bit boring, and technology definitely like brought more excitement to the table.
Walk us through the origin story. How did you start the startup? Like, what motivated you to do it? What was the problem?
I think the fact that I could like do it is, you don't really need to do a lot of. I know how to code from school, and so in most laser physicists do. or just most physicists like know how to code, because you have to run experiments, you have to write some scripts. So so I educated myself on like Ruby on Rails, build the startup and basically like push the team. And it felt like, this is like cool. Let's just build something and see what yields. We didn't really put too much thought about like what will like the monetization strategy will look like, and what would be like the online conversion funnels. So it was more a entrepreneurial urge to just do something. It felt like after, and it was around the time when Facebook got public. So as you can imagine, it's like you read like this is $100 billion company. You could do it. Like, okay, how it's like you're not different from Mark, and that's the underlying. I think for a lot of the people, like starting something is about that. It's just like going and building something, and like maybe like as a repeat time entrepreneur, you kind of like really self-impose a lot of restrictions, and you really think about, okay, is that a really big time, and is that a really big idea that I'm like passionate about it. But like when you do the first gig, it's a lot like why don't you just go and do it?
Yeah, absolutely. So tell me a little more about Flashpoint, your guys' sourcing, screening process, kind of what your thesis is, and what are you guys excited about?
Sure.
What has changed? I would say one more thing before you jump into that is, on the private equity side, there's a lot of innovation in revenue-based financing. I think there's going to be a lot of software platforms that can like use the financial data, like these fintech companies that are out there now. You can plug your financial data in, and then all of that data can tell you, your EBITDA, what your revenue multiple is. You got graphs and analytics from like last year, and you can, a lot of that can be kind of really calculated and possibly be automated. If you want funding, just plug in your CRM and your payment system, and then it could almost be like this AI private equity investor says, look, you're at this multiple. The business that you're in is a $2 billion market size. Here's your competitors, because they pull in all the data from Facebook or whatever. And a lot of things that we use our mind to do, I feel like there's now nodes and structures that can probably put that together in that way to possibly like offer a transaction. Right? And I don't know what your thoughts are on it. Like, how far away are you? I mean, there are softwares that people use to augment that process. And then, on the founder side, there are softwares now that like founders can go in and, kind of explore funding, revenue. But where do you see that intersection at some point where private equity VC investors are?
Yeah, I think, the VC like organization, that we invest from is basically it focuses on kind of Series A stage when it's still like relatively early, and so there are still a lot of unknowns, and they're all high growth businesses. So when we come in, they tend to grow like 100%, 200%, 300%. So and so there is a lot of still uncertainty about like what's to come, and how long will that persist, and how scalable the user acquisition channels are. And so when we started Flashpoint like 12 years ago, the first fund was more consumer centric. A lot of the markets weren't really still taken, and so we backed like company like just.com. And it was like basically a play on mobile, and they were just getting into the App Store and Google Store, and so that played out quite well. Eventually, General Atlantic acquired that business for about $650 million, and so we backed a company like Shazam, which got acquired by Apple. So and so in Fund 2 we went into B2B like motion and marketplaces. In Fund 3 and backed companies like Guesty, which just announced like a Series F from KKR. And so in Fund 3 we went predominantly into continue to do more like B2B software. So 95% of what we do today is B2B software. And then, we also started to focus more on like AI and machine learning as like those technologies really got, mainstream adoption. And, we're now, companies like Test Trigger, which were backed a few years ago, really started to, generative AI has really been at the forefront. So I think, in terms of as a generalist VC fund, I think you really need to be, anticipating where the puck is going and, not where it is today.
Sure.
And as we, start to raise our fund 4, we're also thinking about like climate technologies. I think over the last like couple of years, there's been a lot of talk. I think the regulation is coming, or it's increasing, and there is a lot of like net zero talk by public companies that it's important. I think the social movement also propel that path forward, and that it's you'll not just need to make money but also be socially responsible. So all of that impacts corporates to start paying attention. So so that's one of the sectors where we're spending more and more time. But today 95% of what we do is B2B software. This is the most, I'd say, predictable and scalable way to make money. I mean, if you got the product right, and at a Series A stage, you kind of get that just, is there a net dollar retention? How good? Usually the company by Series A stage has, 20, 25, 30 people. So you can already get a feel of, whom can the founders hire and how good are they at hiring the first level of, execs or middle managers. Maybe it's still not that VP level person, but, it's head of somebody. And so you can get that first understanding how good like the founder is able to transition out of a founder role into kind of a CEO role. It's still not like to the fullest extent, but because that typically happens by kind of by 10 to $20 million that when they really phase out and really like kind of grow into their professional CEO roles. But you can get the gist, like how the founder thinks, what is his action steps have been to really grow into kind of a ex-founder to like a proper CEO role. But VC has definitely changed quite a bit over the last decade. But if you're not curious, where the markets are heading, and you're not always like researching and grinding, I think it's a very competitive market in general. So.
No, absolutely. What are ways that you're able to parse out AI out? For a lot of these AI companies, there's companies that are not AI companies, but now they're branding themselves having some type of automation or AI. So when you're diligencing these companies, maybe in the first or second pass, what are some telling signs that maybe this could be a winning team, especially in the early stage?
Yeah, and I mean, not all AI is created equal in that sense. I think if you look at how the value capturing is taking place, you see that a lot of the horizontal SaaS companies, the ones that have been built out over the last decade, from Workday to Salesforce to HubSpot to ServiceNow to UiPath, you name it. There's a lot of horizontal SaaS companies, and so a lot of the value that AI has really created, with GPT models specifically, and with the LLMs being the core capturing mechanism, is where those companies will more likely to capture value rather than the new companies. And so when we look at certain industries, this is where we believe with AI that there's going to be value created. So for instance, in hospitality and travel, we've built a solid track record, and it's an industry that is not very keen to innovate very quickly. And so people who know the industry, who've got relationships in it, when applying AI and LLM specifically to a set of problems, there is long-term modes created because there is a business mode. It's very like not an easy one to get in. Like construction is one of like other niches. It's very hard to actually build something if you're not coming from a construction industry. You really have to love what you're doing, and customers need to understand that you breathe and leave their industry, right? Also healthcare, like it's one of those niches where it's like not everybody can go and just build like productivity SaaS tool. So we look for founder product fit or founder market fit. And so we want to understand that the person has really lived through the problem. And if he hasn't, she hasn't, that's a really red flag, because it's very hard to like build sustainable value in those industries if you haven't really lived through the problem like yourself. But also in the world of AI is like, how much data do you have? Like a company like Test Trigger as an example, it processes like 1 million tests a month, right? So they've got internal data done by the QA tests. And so they can train their model to actually generate new value. And so if you're like trained, because if you look at all of the LLMs, now that Apple has trained their own model, and their last model is much more smaller parameters wise versus like OpenAI's model, and it's already on par, if not better. So it kind of tells you that if you're taking the same exact data set, whether that's Quora or open internet scraping and or some other data sets, Wikipedia and like or others, basically like there is no like ultimately value. Everything just gets cheaper. And the question is who's got the faster model in that sense. But if you've got like proprietary data set, this is what's valuable. And so if the company like doesn't have it, it's very hard to create like a sustainable value and mode, technological mode or product mode in the era of AI. So this is like some of the things that when we kind of look at Series A stage, whether there is just besides traction, is how much of a like founder market fit is there, and like how much data mode is there really.
How much well, let me rephrase. What advice would you give to someone who's evolving from maybe from Fund 1 to Fund 2, and now you guys are on Fund 3, right? So like, because it sounds like you guys had a little bit of a pivot even in the industry focus, right? So how should people think about that as they're building their institutional firm, and how should they tell that story to other people?
I think just like any business, you cannot stop selling. So if you're a fund manager that kind of like raised its first fund and like kind of thought that you could stop fundraising, you can't really stop fundraising. You're always fundraising. And just like any entrepreneur that is actually running like the company, that's the companies that you invest in. So it's the venture capital business is really operates on constantly raising money. It takes time to build trust with limited partners, and so they understand your strategy and how unique you are versus the rest of the market, and how you can build systemic alpha. And so if you're not constantly raising, it's like you're going to have challenges, because it's not always up and away. Sometimes I'd rather say that VC is a chainsaw business. So everything is like great until it's not. Then it's like you just drop dead. And so it's a very complicated model from funding perspective, because everybody's kind of like it's a game of musical chairs. So if you're not constantly raising, it's you might have challenges, and so you need to keep on doing that. I think you need to love what you do and always be curious. If you're not specific in general, this is a business about like curiosity and how to structure that, how to farm that insight out of the market, and provide capital to people who are also curious enough and builders. But just keep on learning, and keep on reading, and keep on talking to people. And this is an industry where you will make mistakes. Everybody makes mistakes. And so I think it's a question of how can you quickly reflect on your mistakes, and learn from it and move on.
Yeah, absolutely. Well, this was really great. Really enjoyed getting to know you a little better. Thanks for making time for us, and excited to stay in touch and hang out in New York at the next cocktail event.
Awesome.
All right, man. Take care.
Take care. Bye.